Good morning, everybody. We'd like to welcome you to our digital business breakfast. My name is Maciej Meder, and I'm Managing Director at ZEB Poland. And I have a pleasure to moderate today's meeting. We would like to continue discussion on the ESG topic, and this meeting will be dedicated to the ESG in the investment fund industry. Our agenda covers today three major points. We would like to present results of our recently conducted European Sustainable Fund Study, an overview about major regulatory requirements for funds industry in the ESG area, and last but not least, our recommendations for asset managers on the approach to the ESG topic. I'm very happy that two of my colleagues join me today to provide their insights into the ESG topic. Let me introduce to you Manuel Hobisch, who is Senior Manager with ZEB and our topic lead of ESG topic in capital markets. Hello, Manuel.
Hello, good morning, everybody.
And Tommaso Cavalli, who is a manager with our Warsaw office, but great deal of time he spends on international projects for large European banks and asset manager. And he was the leading author of our European Sustainable Fund Study. Hello, Tommaso.
Good morning. Thank you for having me today, Maciej.
Please note that the meeting is recorded and will be published in a few days on our webpage, www.zeb.pl. In the section events, you can also find our previous webinars, for instance, our webinar or European banking study, also on the ESG topic in general. We would like also to keep our meetings interactive, so feel free to comment and ask questions using the chat or raise your hand function in Teams. You are muted, but I mean, if you would like to contribute, just let me know in comments, and we will, of course, turn the mic on. Okay, so let us jump into the discussion. Tommaso, would like to start first about the study. You performed a very thorough analysis of the European sustainable fund market. Could you maybe tell us first what was the exact scope of your research? And maybe before we go into the findings, also I think that the interesting point is what was your ESG criteria based or classification based on?
Yes, thank you, Maciej. Maybe we could go to page 5. Yeah, perfect. Yes, indeed. So what actually I would like to present to you today is basically the results of our first European Sustainable Fund Study. I'm actually quite proud of this exercise because also on the market, I feel that there are very, very few reports and documentation that actually go in this depth in terms of analyzing the degree of implementation of ESG criteria in the investment fund industry. The starting point for us was the database of Morningstar, which actually collaborated with us in order to perform this study. And our scope, as I mentioned, was on the European domicile funds. Yeah, so we looked at all funds that have a domicile in Europe, plus also funds that are domiciled either in Switzerland, UK, Liechtenstein, and Norway. So quite a broad definition of Europe in order to capture all the key fund domiciles. The goal of this study was, in particular, yes, to make a snapshot on the levels on how actually sustainability criteria are already implemented in investment funds, and try to also make some comparisons between fund domiciles, Luxembourg versus Ireland versus other domiciles, for instance. But as well as also, and that was, I would say, that the key prior one goal was also to understand a little bit more in what regards or in what perspectives actually sustainability is implemented. So we try to go deeper into assessing, I would say, usual funds KPIs and criteria. So we looked at the asset classes, we look at the active versus passive strategies, and so on. Yeah. The study itself was, I mean, obviously you can find the study, and I'm happy, and I invite you to download it from our website, as also indicated previously by Maciek. Otherwise, please feel free to reach out to me or to Maciek, and we can also send it to you directly. The study was, as I mentioned, supported by Morningstar, as well as also had, I would say, the stamp of the Luxembourg Fund Industry. So these were our two key partners for this study. Let me, also mindful of the time, but still let me give you a couple of more details on the perimeter of our study. We focus on open-end funds only, and exchange traded funds. Yeah, so we did not look into closed-end funds like hedge funds and so on. And as we actually had Morningstar database as our basis, the coverage was of course very good in terms of UCITS fund, and included only regulated AIFs. Yeah, so non-regulated AIFs were not part of our analysis. In terms of sustainability criteria, going back to your question, we use Morningstar definition of sustainable fund. Yeah, we will have, I think, a long discussion afterwards in terms of the different criteria used by various providers. Yeah, so our basis was Morningstar, which is obviously a well-recognized provider in the fund industry, especially among all the providers in the, I would say, UK, Luxembourg, and Switzerland area. What do they define as sustainable fund? Yeah, so Morningstar define a sustainable fund, a fund that actually has or focuses primarily on sustainability. And this doesn't mean just simply making some exclusions, some negative screenings. Yeah, so if a fund, and whereby more or less almost all funds today actually apply some sorts of exclusion criteria, be it tobacco industry, pornography, and so on. So these kind of funds that make exclusions do not qualify as sustainable funds for Morningstar. So they have a more restrictive definition that really says, as the footnote here states, that the fund itself must focus on sustainability, impact, or ESG factors in their investment strategies, and it must be also accordingly recorded in the fund prospectus. So basically, the value added by Morningstar here is that they check each and every fund documentation, prospectus, keyed fact sheets, and so on. They also obviously have some interviews with the fund managers, and then they make their classification. Yeah. So this to put a bit in the framework, our starting point.
Okay. So maybe let us move towards the major findings. And I think what everybody is really interested in is if you found any evidence that the ESG or sustainability topic is really gaining importance in the fund industry.
Yeah, I will maybe use our page number 7 of the presentation as basis. Definitely. So we obviously hear on the news, we read it on the newspapers, in magazines, in reports, and so on, that ESG factors are now more and more considered. The numbers actually prove that. Yeah. Let's leave aside for a moment the discussion on greenwashing, but what we see also in terms of figures, as we see on the left-hand side, where we actually looked at the assets under management linked to European funds. In the dark and light blue actually boxes, you see how numbers actually increase, meaning that in the last 3 years, the share of sustainable funds net assets compared to the total net assets managed in Europe actually increased pretty much almost more than 3 times. Yeah, so we went from 5% in 2018 to the latest data for June 2021, say 18%. So let me repeat. So 18% of all assets under management in European domicile funds are actually linked to sustainable funds according to Morningstar criteria. I would say that this is quite a significant increase. Of course, within this, there will be some funds that potentially apply some sort of greenwashing. But as mentioned, Morningstar is quite restrictive, and not only they check the documents, but they also interview fund managers. So I'm quite trustworthy I'm quite trustful that actually Morningstar is quite able to try to remove a large deal of funds that are not sustainable from here. What we see also very interesting on the right-hand side, the net new money coming in on these funds, what we see is that already as of 2020, half of the net new money is already directed to sustainable funds. So this is, I would say, even more significant. Yeah. So we can expect numbers to increase in terms of assets in the upcoming years. Yeah. Another factor that I would like to point out from this slide is, I would say, the dark blue versus the light blue numbers. Yeah. So what we see is that, as one could also imagine, the push for sustainable strategies is in particular led by the active strategies, yeah, by active funds. There is quite a debate on active versus passive, as for also other conventional funds. So I'll not go too much in detail into that, but in our study, we also have a supplement with an interview that we did to key players in Europe. One represented the active strategies and one represented the passive strategies, and both actually presented very valid reasons why sustainability can be implemented in both of these words. Again, as mentioned, largest share of funds, sustainable funds in active strategies, but passive are picking up as well. You can see, as mentioned in the light blue numbers, it's now representing 3% of the overall assets pool. And in terms of sustainable funds, only passive are now representing approximately 20% of the assets. Moving on in the next page, page number 8, a lot of numbers here might be a bit confusing to see on the video. Where I would like to point your attention is actually on the following aspects when we look at the funds asset classes. Equity funds are also similar to active strategy. Equity funds are also, we say, the largest or the most significant category of sustainable funds. Also here, I would say quite well imaginable as within equity strategy. Obviously, the fund manager can actually have a more significant impact on the underlying investments in terms of voting rights and so on. But what we see, especially starting from 2020, the columns in the middle of the chart, is that the integration of sustainability criteria is becoming more significant also in fixed income funds, as well as also in more balanced like multi-manager strategies. Yeah. So also this, I would say, gives a perspective on the increased maturity that I would say is visible in terms of implementing ESG criteria. So as one can imagine, at the beginning, equity funds were the natural, I would say, candidate how to actually implement ESG criteria. But we are now see fund providers implementing and try to actually implement ESG criteria also in, for instance, in fixed income funds. Yeah. Maybe another detail that I would like to give you on page number 9. Let me maybe go a bit more in detail on the sustainable criteria and what kind of sustainable funds are actually tracked by Morningstar. Morningstar actually uses 3 major sub-levels to define sustainability criteria. And they start from a more, I would say, generic ESG fund, which are the fund that integrate ESG criteria in their investment process in a more light way. There is a second level of sustainability, if I can call it this way, more in between. So what they call environmental sector funds, which are, I would say, funds or strategies that invest into environmental related objectives. And then they have the so-called more green or greener funds, which is what they refer to as impact funds. Yeah, I think impact fund is anyhow a terminology quite well known on the market. Yeah. So these impact funds are the funds that actually have a concrete and well-specified goal within their investment strategy. Could be improve the accessibility of water or in underdeveloped countries. Could be impact funds that address or try to improve carbon emissions. So these are very specifically targeted funds. What we see on this slide is how we try to actually show the evolution of the so-called impact funds in the last years. Yeah. Obviously, also in these regards, at the beginning, fund providers started to implement, I would say, in a more easy way ESG criteria, implementing, as I mentioned, ESG strategies in their investments, or applying environmental considerations. Yeah. But what we see in the last year is that there is a more significant development also of these greener funds or impact funds. Yeah. So really most targeted funds. Let me also specify that, as you can imagine, the definition of a fund in between these three categories is sometimes blurry. Yeah? So in some cases, it's not really black and white, or white and green in this case, I should say, but there are some funds that actually could be classified in more categories. Yeah. So as you can also imagine, the standards and the criteria are going to be developed also in the next few years. Yeah. So it's still common to see in Morningstar database to see a fund that actually change the classification in between years. In order to make the analysis as how can I say, as correct as possible, we decided to focus in particular on the impact funds, as I said, so the real green funds, which helps us really to cluster these funds. Yeah, and what we see here is that they at the moment represent 2% of the assets in Europe. So 2% of the total funds assets are now in impact funds. If we look only at sustainable funds, they are now representing approximately 13% of assets. Yeah, the numbers are very similar also on the fund flow. So if we compare with the overall numbers for net new money, we can say that the improvement or the flow of money towards the impact funds is, I would say, more moderate than overall in other sustainable funds. Yeah. But still, it's a trend, and we can imagine that, especially after the rollout of the new regulatory legislation in Europe, we will have a deep dive in the next few minutes. There will be more and more, I would say, flow of money also in impact funds. Yeah.
And maybe, Tommaso, have you spoken to fund managers about, let's say, this structure? I mean, is it the fact that these impact funds are still let's say, this fully green funds are, let's say, less popular? It's because the topic is new and the standards are being developed, or I mean, are there any other reasons?
Yeah. Also on this point, we have actually we made an interview with an impact fund provider from Luxembourg, which was very insightful. Actually, the key remarks that the colleague actually brought us is that. Especially in the past couple of years, when actually this sector or this topic was still quite a niche, there was in particular, I would say, an issue with the exit strategy. Yeah? So obviously these funds did not, and still to a certain extent today, do not yet have a significant liquidity. Yeah. So in some cases, it's the exit strategy might be difficult, and this also was a little bit of a challenge for investment into this sector. And a second point was that you also need quite some expertise in terms of, how can I say, making a proper assessment on what is impact and what is not, yeah? So, and this kind of expertise, I would say, is still being developed more commonly in the market, and obviously was until now a prerogative or a prerequisite of more institutional investors. Yeah, so until now, the share of retail investment into this kind of funds was quite limited. Yeah, but the expectation also here is that thanks to the regulations and the clarity on what should be real green funds and what not, potentially the trend should, as I mentioned, change and focus be more directed also on these green funds.
But when we already talk about the retail and institutional investors, I mean, have you also explored about, let's say, the target clients for the funds? I mean, are they still dedicated? Because, say, the share of which you presented at the beginning is already relatively high. So the question is it are these institutional investors who are very much focused on this topic and this drives the offer of funds towards this group, or it's rather a topic which is more prominent among retail investors and they are seeking for new funds in this area?
Yeah. Well, as I just mentioned, I mean, of course, the initial push was driven by institutional investors, yeah, due to, I would say, marketing purposes, the overall image of the or reputation of the company towards end investors pushed financial institution, pension funds, and so on to lead actually the investment into ESG ESG funds. What we have done as a kind of a proxy of the development of the implementation of sustainable criteria in the retail segment, what we have done on page number 10 is actually to try to take a look at the retail share classes. Yeah, so we went into the numbers and see how what is the development of sustainable funds within retail share classes only. What you see here, as you actually, it's quite visible on page number 10, is that also within the retail, I would say, ecosystem, if we use the number of retail share classes as a proxy, also in the retail environment, we can see that the trend is picking up. Yeah, so there are more and more, or clients, retail clients have more appetite for this kind of investments, and providers are starting to roll out on or to launch more and more share classes also dedicated to retail investors. Yeah, I think also that what has happened in the past couple of years after the Paris agreements and the I would say the movements also of our youth generations, the strikes is really pushing more and more attention on these topics, and the fund providers have started to launch more and more products. Yeah, so to give a number, as you pointed out in the first slide, we show that 18% of assets overall in Europe were directed to sustainable funds. If we look at retail share classes and we look at the number of share classes, 13% of funds actually have a sustainable flag. Yeah, but also here the number is more than double compared to 3 years ago. Yeah, so it went up from 5% to 13%.
Okay.
Yeah, and yeah, exactly.
Okay, what are the other findings? Because we would like to slowly move maybe towards the regulatory requirements.
Maybe a couple of more.
Conclude.
Yeah, one more remark also on page 11 on the, as I just mentioned, the launch of new funds for the retail share classes. But on page 11 we have an overall view of new funds launched. what you see here is, and that's actually what I would like to remark, is that there are obviously two ways. Yeah, either a fund providers launch a new fund with a sustainability, I would say, objective, and this is what you see on the left-hand side. Be aware that the numbers for 2021 is not annualized, so it's a number for half of a year. So if the trend continues, we can expect basically the number of new funds launched with sustainable criteria to be in the region of 600 funds this year, up to 500 last year. But the second way, or the second opportunity for a fund provider, is also to repurpose an existing fund. Yeah. And I just received actually this statistic from Morningstar 2 days ago for 2021. The number is really striking. Yeah. So I went back to them to check that that there was no mistake. But what the numbers show in their database is that in the first semester this year, more than 700 funds in Europe have already been repurposed. Yeah, meaning that a fund that was previously managed as a conventional fund by the fund provider has now been retargeted towards sustainability, to integrate sustainability criteria. Yeah, and this is not just a marketing name change of the fund. Yeah, so this means that the fund provider have also gone through the change of the investment strategy, change of the fund documentation, and so on. So it's quite a significant, I would say, trend. In terms of active passive, very quickly, is, I would say, similar structure. So active funds mostly, but also with increase in passive new funds. And overall, you see just the trend. So the numbers for sustainable funds are going up. The numbers for conventional funds are going down. Yeah, so more and more funds launched have a sustainable criteria than pure conventional funds. And quickly, last one on page 12, just to give you a bit of a feeling on what are the markets or the domiciles that are leading the pack. Also here, as one could imagine, the Nordic countries have a higher share of sustainable funds. And France in general is the number one domicile according to the numbers. So France domicile funds have a higher share of sustainable funds. Yeah, so we see fund providers like BNP, Amundi, AXA with already quite high share of sustainable funds.
Okay, quite interesting. Okay, maybe let us move. Thank you very much, Tommaso, for this insightful presentation on the study. We will come back to some aspects also later. But maybe now let's move towards the regulatory topics. And Manuel, if you could give us an overview about the major requirements for the fund industry. And which are, let's say, the most critical for asset management industry in your view?
Yeah, of course. So first, I think, let me say, with the European regulation regarding ESG, we will see a moving target for the next years. So currently, the first regulation is finalized and already in implementation, but especially regarding the environmental perspective, of course. But we have other topics where we are still missing even the draft of the regulatory papers. And however, many initiatives have to ensure sustainability along all dimensions of ESG. And so, for example, for our first topic, the taxonomy and the disclosure obligations, we currently have a final paper for the environmental part. We have a draft for the part of social, so the S of the ESG, but we are still missing the governance part for the G. And so the market participants are mainly working on the integration of the regulation based on environmental. Beside of that, we have final versions of UCITS and IEF regulation, what is also very important for the asset management business itself. We have, on the other hand, the regulation regarding benchmarking. So the good news on that side, that is not a topic for the user. So that is only for the companies producing a new index. But without of that, also important. And last but not least, we have the green bond standard, which was published by the European Commission in July of this year, and it's also going to an end. And if we look how that would affect the fund industry. So if we move to the slide 16, I think it was, with the taxonomy and the disclosure regulation, the focus is on the publication of sustainability relevant criteria based on the categorization of different investment strategies. And that is in typical style of European Union as a legislator. No binding bans or specifications, but many publication requirements. And I would say the hope that regulation is done by the market itself based on this transparency. And as what we can see currently from the market participants like rating agencies or even Morningstar, as we discussed before, or also by investors, they define stricter rules for themselves than the regulator does currently. And so they think they need more sustainability in their investments, especially, you already mentioned the institutional business. They say, okay, we need more stricter rules to align to our own ratings and ensure that we reach our ratings as sustainable provider for especially in this insurance business and so on, than the regulation does. But let us have a look to the other topics. The amendment of UCITS and IF that focuses to the integration of ESG risk to the portfolio management. And so the asset manager will have to define if, and if yes, how we want to consider ESG risks by managing the portfolio itself. And beside of that, the product provider also has to adopt his target markets and with ESG criteria and consider ESG as another conflict of interest within the investment strategy. The benchmark regulation, I already mentioned before, defines a minimum standard for the climate benchmarks and should develop a consistent reference for the capital market products linked to such an index. And the good news, I already said before, that there is no user regulation, so you're only affected directly if you provide or calculate your own index. And I think that's not the many of banks or asset managers who do that by their own. The really biggest change and the most effort for the investment business overall will be the amendment of the MiFID II, and that especially for the distribution entities. So it consists of an integration of sustainability to the advice process. So from mid of next year, you have to ask clients for their demand on sustainable investing and consider this answer, of course, for your recommendation. And so if you ask a client, so do you want to invest sustainable? I think nobody would say no. So normally the answer will be yes, and that reduces your product portfolio to the sustainable products. And that could be a problem for institutions who have a very conservative product portfolio, or also product providers. They won't offer or couldn't offer any sustainable products, so only a small portfolio of them.
Mm-hmm. But Manuel, would it mean that additionally to the current, let's say, horizon and risk propensity and knowledge of the client, distributors will also have to interview the client about the ESG or let's say their ESG needs, and then if I understood you correctly, the recommendation, if the client says yes, I'm extremely oriented towards sustainability topic, then it would mean that in my recommendation as funds, I should see only ESG funds or some portion of ESG funds. I mean, and ideas how this would look like.
Mm-hmm. Yeah, I think that is how intelligent you ask the client. So as I mentioned before, if I say, do you want to invest sustainable? And the client says yes. So that means that I would define as every investment I do should be sustainable. And then I think we come to this problematic situation. I have to look for products who fulfill these criteria at all. And I think for example, if you ask the client how important is sustainability for your investments based on a scale from 1 to 5, or how much of your investments overall do you want to ensure sustainable? So I think you can define those criteria a little bit otherwise, so to change the result and to ensure that your product offering is also suitable for the client in the end. But of course, you also have to report how the recommendation or the products you offer will suit to the answer of the client. And I think in the end, there we will have exactly this problem. The regulation also says if you do not have a suitable product, you're not allowed to recommend any. Mm-hmm. And I think that is a real a problem for the distribution parties in this case. And on the other hand, not even after 5 years, MiFID II came into force, we now have to change all these defined processes and adjust IT applications, and also, of course, invest to new or additional data packages to ensure how sustainable are those products.
But besides the complexity, of course, I mean, I see this as a big challenge. Of course, this kind of requirement might push the demand for ESG products dramatically.
Yeah. So, so the European Union says all the ESG regulations should be in a chain. So they should cover the whole value chain of the investment business, and that shows with MiFID II, we will have an increasing demand for sustainable products, and on the other hand, we have product provider who have many obligations regarding the reporting and the publication of sustainable information about their products, and that overall will increase the volume of sustainable products. Yeah, of course. The last part we have here from this definition, we have the European Green Bond Standard, and as the name already mentioned, it says it defines a framework like the reporting requirements, the setup of policies, and so on for the emission of green bonds. So what is more interesting is what is a green bond, of course. So first of all, it is a typical bond, but the special thing is what the issuer is allowed to do with the capital raised. So simplifying that, he has to support something like a balance sheet and to ensure that the capital raised is invested based on sustainable criteria. So for example, if we think about a bank as an issuer, the bank has to ensure that there are enough sustainable assets like green mortgage loans, for example, to cover the volume emitted along the full lifetime of the bond. And that is a new criteria of bonds and a new investment form we define by regulation now.
Mm-hmm. Okay, if we look on the list, and as you mentioned by you, the disclosure, the ESG related disclosure topics seem to be one of the major challenges for the industry. Maybe if you could elaborate a bit more in detail about here the requirements, what is already in force, what is coming in the future, and what challenges are resulting out of these new requirements.
Yeah, exactly. So let's have a look to the overall value chain on slide 17. I think we can discuss it there. So if we look there, we have an impact of ESG regulation overall to nearly every stage here along the value chain. The disclosure obligation is covered by simplified, I would say, nearly every of these topics where we have a green or a blue field here. And why is that? So as you can see, the product management has first of all, to adjust, of course, the product criteria and the product governance process. And integrate sustainability for new target market criteria. Okay, so I think that's fine. That's also possible. Of course, you need data, but I think that should work with not so much effort as currently discussed. Research, first we'll have to integrate ESG with new or additional material. They also need that for the investment decision afterwards, even for new product classes like the green bonds, for example. And the portfolio management itself has to adjust the whole investment strategy and even the whole investment process, so with a sustainable focus. And they also have to consider the criteria based on the taxonomy or the disclosure regulation, because in the end, the investment company has to report on a fund level. How does this fund cover these criteria? How does it fulfill it? What are the values behind of those criteria? And so the investment process itself has to ensure that these values are on a market competitor-based scale, and they are as attractive to show that we are a sustainable investment fund manager. And if we look to the investment support, I think there the focus will be on the data management, and they are affected especially regarding the new data needs. And I think about the data governance, where can we get rich data for the different asset classes? And we currently see that is a very difficult topic, because the European frameworks of disclosure cover only the European industry. But investment business is a global business, and other countries and also their companies won't care about our data need in Europe. And that's what we see currently in many projects. That means what we will have to do is to promise to the data provider that they are able to collect this necessary data, because nobody can do that by himself. And what we currently see, it seems to become a big mess with the data collection so just one example, in one of our provider selection projects, we sent a portfolio with different assets to different data provider, and simply said, some of them said, okay, no, we do not have the relevant data because it is not set up now, and we know that we will collect some of this data only based on service, because there is no official publication. For example, by a tractor manufacturer in China, so they don't care about our data need. And that's why I was wondering, when I saw the first drafts of this ESG regulation, so what are they doing there? They define a disclosure regulation where there are no data available. The output of the report won't help any typical retail investor in the market. And just one example, the publication of how many tons of waste per million revenue does a company have, without recognition of the industry, of the product they provide, or whatever. There's no reliable statement for sustainability. And I think that is the overall problem we will see with the disclosure regulation. That is a new report, that is many paper, quite interesting for some institutional investors, but not for the overall market. And that is the reason why we have the highest influence overall in the portfolio management and the reporting, even also to the risk management, because they will have to control these strategies and also ensure the compliance regarding these regulatory requirements. But what I think they will also have to do is they have to support portfolio management with additional scenario models, simulations, and so on, to reduce real ESG risks in the portfolio. And that is not about what the regulation says, that is more about what does, for example, a weather model say, what is about different industries due to the different weather conditions now, and so on.
Okay, do you want to continue with deep dive on the requirements, on the disclosure requirements, and maybe here a short side question referring to your example. But is it will the company, let's take this Chinese manufacturer, will not be mobilized to provide this data because the fund manager would say, I simply need this data, otherwise I will not invest into your company? Would it not work like that finally?
Yeah, so that will happen, and but that's on the one hand side, that means that we reduce our possible investment portfolio in the market. So we reduce also liquidity and so on in these asset classes. On the other hand, we will also see that a portfolio manager normally is no legal guy. So he's not interested in, oh, the regulation says. So this is a market guy who says, I see a company with an attractive business model, with attractive revenues, with an attractive price-earning ratio, and I want to invest to that. And it doesn't work, and I'm not allowed to. So we will see many frustration in this business area of portfolio managers due to this regulation and due to these new challenges they have in the daily business. And of course, also that means that we will have more controlling of what does an investment manager do along this value chain. So the risk controlling will also have to control about for example, more about the order management. What do they buy? What do they sell? Is that okay regarding the ESG regulation and so on? Do we have the data we need for the reporting afterwards? So this overall chain is currently changing, and there is more power for controlling and regulation. But looking forward to the slide 18 about what we said before. The disclosure regulation is simplified said based on two topic blocks. The one side is we have the company level, where we say how do we cover sustainability in our strategy, in our overall investments, how does it impact also, for example, the remuneration of our own employees. So do they have a target to work on a sustainable basis, and how do we work with adverse sustainable impacts? So that is already enforced since the 10th March this year. Normally that is, I would say, a 5 to 6 pages report or policy, what is available on the website of every asset manager, and also some portfolio managers from banks. And the second part is more about the product itself. So where we say, there we have to show this report with real figures about the adverse sustainable impacts. That was this example I had before, the tons of waste of a company, and that is aggregated on a portfolio level and reported then on a minimum yearly basis from beginning of mid of next year, then about all products who are defined as a sustainable product or also as an impact product.
Okay, so maybe here a question, because I mean we mentioned also the regulatory view and the regulatory classification of sustainability. Maybe Tommaso, if you comment a bit on, and I know that you compared this Morningstar sustainability criterion, which you mentioned at the beginning was used for your study with the SFDR reporting. Can you just comment maybe on the key findings and the differences between both? I mean, and can we expect that SFDR will be then the leading criteria in the future? What is your view on this topic?
Yeah, very difficult question to answer on the whether SFDR will be the leading point. Yes, indeed, we took a look into these points as well, as you're now showing on the slide. In simple words, what we try to do is looking at the population of funds in our study, compare whether the fund has a sustainable flag from Morningstar, and what is actually for the same fund, what is the classification according to SFDR. First disclaimer, so there should be many disclaimer on these topics. As you see, also the footnote part is quite busy. Morningstar definition, so the numbers that you see in green on the right hand side, these are basically a sustainable flag applied by a third party. So there is an agency, in this case Morningstar, who does a review of the fund and apply a sustainable flag, yes or no. On the left hand side, the SFDR basically numbers, these are based on the evaluation that the own asset managers or the own fund providers make of their funds. Yeah, so this is the first important thing to be mentioned. Second also important point is that the definition itself, as we also try to explain on this chart, do not at the moment entirely match. Meaning, as I mentioned also at the beginning of the call, Morningstar at the moment has a more strict definition of what is a sustainable fund. For instance, to make a simple example and the most important one, certain exclusion funds, as mentioned, these funds are definitely not considered sustainable by Morningstar, but they could be considered as Article 8 funds according to SFDR. In general, Article 8 funds are those funds that promote environmental or social characteristics. Yeah, so a more light green funds compared to the Article 9 funds, and instead are what I referred to before, also the impact funds, so funds that have a real sustainable investment objective. Yeah. So what the numbers show is that, as you can imagine, as SFDR classification is more broad, the volume of assets linked to Article 8 and Article 9 funds, according to SFDR classification, will be higher than the Morningstar numbers show. Yeah. So if we look at the assets on the top part of the slides, as we mentioned before, 18% is the number for 2021 in terms of share of sustainable assets. If we look at SFDR, is 34. Now, to make it quick, what do we make out of this? Yeah, so I was actually just last week in Zurich discussing with a fund manager, and he was just really asking the same question that you asked. So what will investors look at? Will they really look at SFDR, or will they still stick to Morningstar or maybe other fund, other providers? Yeah. At the moment, it's difficult to answer. So there are certain domiciles, certain markets where Morningstar is really kind of a Bible, I would say, if I can put it this way. So what Morningstar says is considered as a kind of a golden source. So top management in these fund managers were leading towards, okay, we need to be really careful on what Morningstar actually defines as sustainable. We need to understand that so that we can apply the Morningstar criteria in our funds, yeah, rather than going for SFDR, the official regulation. In another interview that we also had in spring with other fund managers, they also point to the fact that most likely, going on with time, more and more funds will at least try to apply an Article 8 definition, because it will be more or less the common standard. Yeah. Therefore, it's also a question on how can fund providers really differentiate themselves and get out of the pack in the future. Yeah, and this would be another reason I would point to potentially give more relevance to third-party provider ratings importance. Yeah, but there are many other factors to be considered. We don't have the time. A couple of more hints. Obviously, we will need to look at the sensitivity of also of the clients, the type of clients. Are clients that are more institutional based, so they would also have access to providers information. What is also the market perspective in terms of the end clients? Will they really become more and more familiar with SFDR or not? So there are really many different considerations to be made with regards to this point by a fund provider, and in case I'm happy to discuss also separately in a smaller group.
Okay, as mentioned, as we are heading the last 5 minutes of our meeting today, maybe I would pass back to Manuel just a bit to summarize the key challenges for asset managers, based on your own experience on the analysis of both of, I would say, the market side, but also the regulatory requirements and your project experience. And then maybe we move shortly to some ideas how to move forward and what could be done and how this topic should be addressed by the particular entities.
Yeah. So to make it quick here, so beside of this classification we heard, we can see numerous challenges for the asset managers by the regulatory framework itself. So we will see the complex data requirements we mentioned before, the missing global unity, also the missing European unity regarding the regulation, also very important. Germany is already doing a gold plating in the ESG standards. We will have missing specifications for exotic assets, like, for example, tokenized assets. We have no definition for structured products, derivatives, and so on. We need qualified employees who understand the sustainable regulation, and that is what I mentioned before, also in portfolio management, who are able and interested in discussing this topic. And that means the asset managers have to deal with these sustainability topics quickly and also comprehensively as possible. And that leads me to the challenges we have on the next slide, and I think in chapter 3 already. What we currently discuss with clients and how we discuss that is based on 4 topics. So we currently discuss that always with a more focus than to the regulation only. Of course, we have the authority, but we do also have clients, and the clients are currently the people who define sustainability in the market. And that is one example we currently see. For example, in the nutrition industry. In Germany, they decided last year to ban those plastic bags where you can collect your fruits and vegetables in the supermarket. But they did not ban the plastic wrapped fruits. So the pre-wrapped fruits, for example, 3 peppers in one plastic, who is already in the shelf. But the supermarkets reduced this offering. Why? Not due to the regulation. It was by the changed consumer behavior. And that's why we say the clients are in the driver's seat of sustainability. And as a financial service provider, you have to ensure a customer-oriented offering, even if that means a sustainable. And what is a sustainable will be defined by the client. And currently, they require much more than the authorities do now. And I think that we have to consider in the project. And that's why we start in our project with these 4 clusters here, to say we have to think about the strategy itself. How I want to position myself regarding ESG? How do I want to be a market leader? Do I want to provide the minimum approach, or what else? Something between. The second cluster for us is the operating model. As we already saw in the value chain, there are many areas affected by ESG, but that also, for example, means what's about my travel policy? What's about my company cars? How many working places do we need in our offices? Not only during COVID, also afterwards. What do we do to optimize the working conditions of our own employees and also our providers? And that are the topics we discuss currently for to ensure the sustainable and ensure the credible sustainability of the asset managers and banks we support. Third cluster, also important, of course, the rating and data management. We already mentioned the example of the bad data quality. and the need for the KPIs we have to show. And last but not least, also regarding the development in the risk management, I already said, I think that is more than only controlling and compliance. It is more about how can we phase out this sustainable risk, the real sustainable risks we have, not only the legal requirements, also the future performance needs. So as we said, changing weather conditions, what does that mean for my assets, not only for real estate business, also for industries, they depend on a good and stable weather condition, for example, like nutrition, like tourism. What does this mean for them? And how does that affect my investment business? And I think that is how we work in our projects. And we wanted to show one example for what could be the offering and how can we support. So we suggest the project approach based on these three phases. We have to have a look about the status quo. Where is the business and operating model affected in your house? What is the overall ESG strategy of the company? Which products are already in place or going to be developed? And of course, which data does the company already have in place and what do they need in future? And after that, we define the requirements based on the identified gaps. In most of our projects, we discuss here about missing risk frameworks and policies, missing reporting standards, a lack of data quality, and we try to fulfill these requirements also from the regulatory and the business perspective. And after that, we start with the conception. So we go and start with a milestone planning, task list, and try to fulfill those requirements we defined before. The main target overall is to cover all gaps. So overall, there's a lot to do, and we think sustainability is more than a trend topic. So it is a very important step in investment business. We can and want to help, and so just let us know if we can.
Okay, Manuel, thank you very much, and also Tommaso, thank you as well for being today with me. Unfortunately, we have to finish. Our 1 hour is over, but I think it gave your two presentations gave a very good insights into the topic. But of course, we are happy to continue the discussion. So if anybody of today's participants is interested in continuing discussion with us, feel free to reach to us. The presentation will be distributed today. In a few days, also on our webpage, we will publish the recording. So if you missed part of the webinar because you had to rush to another meeting, feel free to visit our webpage in a couple of days, and you will see the recording there. Once again, thank you, Manuel and Tommaso. Thank you to all participants for being with us today and following this interesting topic. And we look forward to meeting you in person or during the next digital business breakfast. Thank you very much. Have a nice day. Bye-bye.
Thank you. Bye.